Let's get into it. As mentioned in the announcement section, as well as the introduction video, here's the chapter 1 video. And what we'll be covering here is the concepts, the main concepts in this chapter, the ones you need to know how to apply on assignments, on tests, and just overall to get a foundation of accounting going. This chapter covers the foundational concepts in the course that will be relevant in the coming chapters as well. When you grasp the foundation of it, everything else you can build on, right? So, what are those main concepts presented in the chapter? An accounting equation. We'll talk about what that is, how it is impacted by different transactions in a company's operating cycle. We'll talk about what accounts are. The main categories. There are 5 main categories of accounts that we will go over in detail. The financial statements. What are the main ones? What is included in them? What is the purpose of them? And how are they all related to each other? Okay, you cannot do them out of order either. They need to be done in a specific order, because if you do them out of order, you won't be able to do them. So you'll see how they are dependent on each other, how they are related to each other. And the course actually, or the chapter actually starts with theoretical accounting knowledge, which specifically is about the business structures. So let's say you're talking about a sole proprietorship compared to a partnership, compared to a corporation. To grasp the differences between those, you realize that when you form a corporation, when you create it, you are essentially splitting into 2, and then that second piece that has just been created is a corporate legal entity that all correspondence with that business, let's say it's a liability, a lawsuit, right, related to the liability, taxes, okay, correspondence from other corporations, being on the market, on the share market, on the stock market, okay? When you're a corporation, you're on the stock market. All of the we'll call them attributes that come with the formation of this corporation. So back to the ownership and the liability. When you create that legal entity, you are now the owner who is standing behind that legal entity, and all correspondence is being conducted to this invisible phantom, the corporate name. As opposed to that sole proprietorship and partnership, where there is no legal entity, invisible name. It's you. It's your physical being, your name, attached to that physical being. That's who the liability is coming after, if we could use that word. That's who is responsible for all the liability, for all of the taxes. All the business's taxes are your personal taxes. In a partnership, those partners can work it out by negotiating a specific contract based on what they bring into the business, based on how much time they can commit to the business, based on different factors, but they are still liable in that structure more than they are in a corporation. Corporation provides gives you the least liability as an individual. You are able to do all your business through that corporate entity. So that's the main thing to know about those differences. We're not going to go into that much more depth in the video. I want to cover the main parts that you need to apply. But for the purposes of this course, know that. Go over that in the PowerPoint presentations, read about it in the chapters, and you should be fine for the test. for those type of questions, I put them all in multiple choice format on the test anyway. You don't ever have to write anything out in this course. You won't have to write out any sentences or essays or paragraph answers on the test. This is all about applying, all the tests are about applying accounting concepts with the numbers, and then any theoretical part will be done through multiple choice or true and false. All right? Now, we get into the other theory part, the main part of this chapter. Other main theory part of this chapter is the guidelines, the accounting principles. Generally accepted accounting principles, acronym is GAAP, is now represented by what's called IFRS, which is International Financial Reporting Standards. And those are in place to ensure that all business being conducted globally, and since this is now more and more of a global marketplace now, that when you're doing business with somebody in Argentina and they are sending business correspondence over to Ghana, that all individuals that the relevant individuals in those two countries based on in those businesses can receive that correspondence, can receive those financial statements and process and read them and interpret them the same way, regardless of the differences in language and culture, right? And that gets us to what accounting is for. What is the purpose of accounting? The purpose of accounting is to communicate. And how are you communicating? Through financial statements. And what do those financial statements include? Numbers. Numbers that, based on what they are, tell us how well you are managing your assets, how much revenue you're able to generate based on your efficient management of those assets, how much expenses you are incurring, the percentage of your expenses related to your profit, right? We'll talk about all of those details. But right now we're just saying in general terms that we need to be very clear in how we are communicating those numbers and consistent regardless of where you are in the world. And what ensures that? These guidelines, International Financial Reporting Standards. That's what they're in place to do. And there's a third one called ASPE, Accounting Standards for Private Enterprises. Now those are for private businesses that can adhere to just those principles, meaning they don't have to follow the IFRS, although they are very similar guidelines anyway. It's just what's more pertinent to a private enterprise compared to a public. Public where you're getting now into being on the stock exchange perhaps, and different changes that occur as a result of being under the IFRS designation. But a private enterprise has the option of going to IFRS. It could stay under ASPE, but a public company must follow IFRS. That's the distinction to make there. Okay? And we already know about that corporation. And really, the principles to know, again, for multiple choice purposes, you don't have to write them out, you don't have to memorize them to write them out. But we'll go over those briefly. To know is the principles related to GAAP. So they're the guidelines that all the companies are supposed to be in agreement with, right? And in compliance with. So first one is the reporting entity. You see that? Yeah, you get the gist, right? There's a little bit of glare, but I think it's legible enough. And really what you're talking about here is if you have multiple businesses, you are making sure that all of the information and all of the numbers are being recorded separately for each of those businesses. Of course, it becomes very simple if you just have one business, but that's the point. You're not combining revenues, you're not combining valuation of assets, you're not combining liabilities, of course. All of that. Everything is staying separate and organized. Make sense? We don't need to hear about your salon business if we're inquiring about your baseball card business, if those still exist, right? Cost constraint, number 2. Let me change that. Yeah, you got it. Number 2, cost constraint. When we're preparing those financial statements that we're talking about, and all financial information, we're making sure that it's costing us less than the benefit that will come about from that, right? It's just like why you're in business in general. You're always looking to make a profit. You're always looking to get the cost lower than your revenues. Otherwise, there's inefficiency. There's mismanagement, right? So similarly here, when we're preparing those financial statements, we are making sure that the cost of doing that is less than the benefit that will come about by doing that. For example, when we're sending from Ghana to, you remember where the other country is? Argentina. When we're doing that correspondence, let's say in either of those countries there's a potential investor into the company in that other country. Or you're looking to expand into that country and therefore gain a bigger market, more customers, right? So that's your potential benefits. More investment, more customers, more profits, right? And that's what we're talking about here. Number 3, going concern. Going concern principle, where you just want to know that the company is going to be around for the foreseeable future. You want to know that it's not just a company that was formed yesterday and will be gone tomorrow. It needs to be somebody who has preferably a history, a track record, who has proven performance, right? Has shown their earnings per share, that has had at least a steady, if not increasing, rate. And we look at their past patterns, their past performance, to get an idea on how they will be still doing in the future, right? So that's what comparing all previous years' financial statements will do, and researching the company you're dealing with in general to get a confidence that they will be around. Okay, that's what we're talking about with number 3. Number 4, currency, where those numbers that are being reported are just going to be reported the same way. So when we're talking about Arabic numbers, and Arabic numbers, by the way, are the numbers that you know, 1, 2, 3, 4, 5. They're called Arabic numbers. So if we're going to be using those, then everybody is going to be using them. And IFRS will stipulate that that is required when we're talking about currency, okay? And maybe the money sign, maybe the decimal points, so that everything can be interpreted the same way, right? That's why it's all relating well with the guidelines that we are heading this portion with, right? Number 5 is the revenue recognition principle. Okay, so we mentioned revenue, and we'll talk about it in more depth coming up. But as soon as we generate that revenue, we are recording it. You see, you make a sale, regardless if you made it by receiving cash or credit, you still make the sale. It's still considered revenue. And when it is generated, that's when it is recorded. That's when it is reported. on the financial statements, specifically the income statement. We'll get to that as well. So that's what we're talking about. When it was recorded, that's when, or when it was generated, that's when we record it. And if everybody's doing the same thing, we have an idea on how they did exactly this month, this year, this span of 4 years, whatever range of time you're looking at. Number 6, measurement. Okay, what are we talking about with measurement? Measurement has 3 aspects to it, 3 kind of sub-topics, okay? We can call them, what do you want to call the first one? Currency cost. Okay, we can do that. Currency cost, the second one. Well, first, currency cost. What is the price of something? What could we potentially buy this piece of equipment for? What is it? What is the market price for it right now? What is generally the average market price? But to make it very simple, what is the price of it? As this particular date, what could we buy it for? Okay? Compared to realizable cost. Okay? Realizable cost is now you actually own that asset, and what could you sell it for? So again, market price is very relevant. What is the average market price of that particular asset, vehicle, let's say? What could you sell it for? And then the one that really matters in this one, in this triad, is a historical cost. Because that's what relates best with accounting and the purpose of accounting. Remember earlier we mentioned that accounting is recording the facts, recording the actual values of things, not the hypothetical or subjective values, but the actual price that you paid for that vehicle, or the actual revenue that you received from selling that vehicle if you're, let's say, a car business. But the historical factual number is what is being recorded. So we're dealing with those individuals in Argentina, and we want to know their factual costs and the factual costs that the money that they paid for their assets. Okay, not what we could get them for. We could get them for $200, this computer, let's say, but we actually paid $160. So we care more about the 160, not the 200, right? The 200 is part of the contemplation before you actually make that purchase or the sale. Okay? All right. So there's the theory part that you need to know for this chapter. We won't go, again, you don't have to write this out too much. Write it out at all, actually, in sentence form or paragraph form. These will all fall under multiple choice, but it's good to know what they are, particularly if you are going to be doing accounting, especially if you're running your own business. Because how you prepare the financial statements will matter. So now the accounting equation, and actually before that, let's talk about an account. An account and the 5 main categories where you will find these accounts. So take note of this and remember it all through the semester because it will apply to all chapters. All accounts that we use in this course will fall under one of these categories. Okay, here's the 5 categories to know. Assets, talk about what that is. Liabilities. Okay, 3, equity. 4, revenues. And 5, expenses. Okay? And each of these will have accounts underneath them. What is an account? Well, think about it. You have an account, you have a bank account. It's where inflows and outflows come in and out of. And now you can imagine when you make a withdrawal or when you make a deposit. That's an account. So similarly, each asset will have inflows and outflows. Okay, depending on if it's gained or if it's used. Liabilities will have inflows and outflows, the different accounts. Okay, depending on, did we incur the liability or did we pay it off? Right? There's the trade-off. Equity. How much do we own? Of how much of the assets do we own? Okay? So we'll talk about the equity accounts. Revenues are the different types of revenues we have. Sales revenue, interest revenue, tax revenue. Okay? You have different revenue streams. Each of them is an account. Expenses, in an effort to generate those revenues, we are naturally incurring expenses, and then we have to list each of the expenses as their separate accounts. Utilities expense, gas expense, salaries expense, rent expense, and it goes on, depending on the type of business. So, there you go. Each of those expenses is an account. Each of those revenues is an account. Each equity account, usually it's just capital. Capital represents equity. Capital is the account under equity, right? It lets us know how much of the assets we actually own. And how do we know how much we own? Based on, did we pay them off? But let's go step by step here. Assets. Firstly, we'll talk about assets. What are they? You have personal assets, but in accounting, you know, like your house, your car, all of that stuff. But in accounting, we are looking through the eyes and the scope of a business. Think of when you're preparing the financial statements. Does this matter to the business? That's the mindset when you're preparing your financial statements. It's not about how it is affecting you personally. It's how it's affecting the business. So an asset to a business is any resource that is able to be used to generate profit. And if it's not there to generate profit, then it should not be an asset for the business. Then it should just be a personal asset and managed separately from the business. Assets from a business perspective are used in the course of running the business in an effort to generate revenue. For example, you have a food business, a restaurant business where you're delivering food. So you have a vehicle to deliver that food. That's just one of your assets, the vehicles. You have the building, you have the space, you have the ovens, the inventory, the ingredients. All of that stuff is part of your operation in the business. So all of those are assets. All of those play their part in generating you revenue. Okay? So that's why vehicle is a example of an asset. Here we go. Vehicle, you could call it car. Building is an asset account. Inventory is an asset account. Ovens. You could put /equipment. You could put equipment as a separate account. Okay? So here's some examples of assets. All of those are part of our operation, and they all help us to generate revenue, which we will get to. But that's the goal, is to generate revenue. And if any of those are not helping us generate revenue, we should cross them out and do something else with them. Don't incorporate it into the operation of the business. Okay? So that's how it differs from a personal asset, or what you might consider a personal asset. All right, so liabilities now. Liabilities are debts, to put it very simply. Debts, obligations. We have paid for something using credit, not cash. And now we have, actually, let's separate them with a red, okay? And then go on listing the liabilities. Here, like accounts payable. I'll put A/P. Accounts payable. That means we've paid for something, whether it's from one of our suppliers or any other purchase we've made with credit. And that means we have a debt, and it is considered a liability. But imagine all these things, all of these assets that we have. All of these assets, you're either paying for them in cash or credit. If you pay for them with credit, any inventory item, any piece of equipment, your property, where you're doing the business, your vehicles, if you're paying for any of them with credit, it's considered a liability, accounts payable. If it's a building, let's say, then it would be called mortgage payable, MP. Right? Mortgage payable is more for a long-term liability. Accounts payable is generally for short-term liabilities. Short-term, long-term, by the way, within a year, beyond a year. That's how you know, generally speaking. And then there's sometimes notes payable. That's another example of a liability, which is really an accounts payable, just with an accompanying, there's a note attached to it promising that you will pay. It's more assurance to the vendor that you're dealing with. Okay? But that gives you an idea on what a liability, examples of liability accounts. Okay? Okay, so there's your liabilities, separate them in red, and now we get into equity accounts. And really, capital is usually sufficient as far as listing the accounts under equity. Capital will represent that. If you have a corporation, you will also have preferred shares and common shares. But right now, let's just keep it at capital, because that gives you a good idea on what it means. And what does it mean? Well, let's go back to our assets. We have the assets now, and we ask, well, how did we get them? Did we get them through cash or credit? We already know that if we got them through credit, that means they're liabilities. But if we paid for them with cash, even if you paid for a portion of, let's say, some of these bigger assets, the vehicle or the building, even a portion of it, the portion that you've paid with cash is considered capital. You actually own it. You see, if you paid for all of it in cash, of course, then it's all 100% capital. And that's why when you're forming a partnership, let's say, even a sole proprietorship, and you bring into the business, let's say $100,000 cash, as well as $50,000 worth of equipment. Okay? That means your ownership in the business is $150,000, because that equipment is just as valuable in terms of equity as the cash. You see? Anything that has been cash invested into the business is ownership, is capital. And capital is the account representing equity. That makes sense? And now you can see the relationship between these first three: assets, liabilities, and equity. Right? You see the relationship because you see the initial assets listed up here, and you say, well, who owns them? Yes, you have the authority to use them. You can use these assets, but you don't own them if you've paid for them with credit. When you actually pay off these debts, that's when you will own them, and then they will become capital. But until you pay them off, they are liabilities. And therefore, who owns them? If you don't own them, who owns them? If they are your liabilities, that means a creditor owns the asset. A creditor owns it until you pay it off. When you do pay it off, again, it becomes what? Right, capital. Okay? So there's your relationship between these three. These three go together. Yes, these are 5 main accounting categories, but the first 3 go together. And then these next 2 will go together as well. Revenues and expenses. So if you need to go over that again, rewind the video to really get what is happening here. But that's effective comprehension if you comprehended it. Revenues and expenses. You have these assets now, so let's talk about revenues first. You have the assets and you are managing them in the most efficient way that you can. And how do you know that you're managing them efficiently? If you are generating targeted revenue and favorable revenue amounts. Sometimes you'll see the word sales if you've generated sales, which is the same as saying revenue. Sales and revenue is the same. Sometimes it will be written out as sales revenue, okay? Sometimes it will be called fees earned. Let's say you're doing a service business, a consulting business, a law firm. Anything that is providing a service, not necessarily selling a product, is considered fees earned. And fees earned is also revenue, right? Remember, these branches are accounts to the main categories that we have listed here, the 5. Right? Sales revenue, fees earned. You can, if you have rental business, you can have rent revenue. Okay? Just the different types of revenue. Interest revenue. Any type of revenue will be organized in its own account. And that is what you are trying to generate by owning the business. Okay? So here's your revenues. And now we get into expenses. You cannot have revenues without incurring some expenses. At least I'm not aware of how to do that. Right? Some way, naturally, in the course of running your business, you're going to have a cost. There's a cost to making choices, right? In economics, it's called opportunity cost. Opportunity cost, what you have given up by selecting one option over another. Here, you're generating the revenue and you are incurring the cost in an effort to generate that revenue. And what are those costs? We could say utilities expense, okay, to the business. Okay, maybe you are doing the renting, so therefore it's a rent expense. Okay. Okay, if you have employees, you'll have what's called salaries expense. Okay. Any expense that you can think of. If we have vehicles as part of our business, then gas expense. Okay. Maintenance expense for, you could say, related to the vehicles or the machinery or the equipment. Okay? All of that. Nins. So, you see the relationship here. That's why these two go together, revenues and expenses, because revenues is not profit. Revenues, you need to deduct expenses from revenues to determine profit. Let's say your revenues, all of these total, what do they total? Okay, 60,000. Revenues are expenses. Hopefully, if you've run your business to any level of efficient degree, you have less expenses than revenues. Okay? You have less expenses than revenues. Let's say 25. So that means NI, net income is profit. That's what it's called. Net income is profit will be 35,000. Okay? That's where revenues and profit differ. Profit is after deducting expenses. And that's why these two categories go together. All right? So rewind that if needed. And if not, let's get into the accounting equation now. Okay? The accounting equation. So use those. Have that list of those 5 categories next to you until you become comfortable to just remember them. With minimal effort, okay? So have them next to you so that you can see how they relate to the following concepts. Here we have A equals L plus E. Assets equals liabilities plus equity. Remember those first 3 categories. You see now where they come together, where they're related? They're related because they make up the accounting equation. And this is called the basic accounting equation. Basic ACCEQ. All right? Is this here. The basic accounting equation is assets equals liabilities plus equity. That means the total of your assets equals liabilities plus equity together. And sometimes you'll see the terminology maybe through reading through your books or in other accounting sources of information. You'll see these two together, liabilities and equity, are called equities, plural, right? These two could be called equities. And if you ever see that word, they're implying liabilities plus equity, okay? But back to the equation, assets always equals liabilities plus equity. If it doesn't, that means you did something wrong. You recorded a number incorrectly, or you put a certain account in the wrong column, or a calculation error, or something like that. But you cannot move on into the accounting cycle. You can't go further until you make sure this balances. Assets must always equal liabilities plus equity. Because remember, we have assets, we total them at, let's say 50,000. Those 4 that we listed, or however many, we listed about 5 of them, I think, actually. Let's say they total 50,000. The equipment, the oven, the vehicles, okay? 50,000. That means liabilities, and this is good for the practice questions and the assignment, is it'll give you 2 amounts. It'll say the amount of assets is 50, the amount of equity, let's say, is 20. So now you determine the question mark liabilities. Equity is 20,000. That means what does liabilities have to be? Right, 30,000. Okay, or it might give you assets and liabilities and you determine equity. Okay, and by the way, the formula to apply algebraic principles, you can rearrange this formula to say the same thing by bringing a factor to the other side of the equal sign. For example, liabilities, assets equal, or excuse me, assets, if liabilities is a positive factor on the right side, that means it becomes negative on the left side of the equal sign. Assets minus liabilities equals equity. Right? It's saying the same thing. And you can also take the equity and move it to the left side instead of liabilities and say assets minus equity, right? It was a plus here. It becomes a minus when you bring it to the other side of the equal sign, equals liabilities. Okay? Any of those are true. Any of those are true, and this will help you with the assignment. I'm sure that's quite straightforward now. And you know it, how to apply it now, as well as how to explain it theoretically, in the sense that you own assets and you say, well, or excuse me, you have assets that you're able to use, but then you say, well, how much of it do I own and how much of them do my creditors own? And that is determined on whether you paid for them in cash or credit, right? If you paid for it in cash, you own it, it's your equity. If you paid for it in credit, your creditors own it, and therefore it's a liability. You see how everything's coming together? You guys are going to transfer into accounting now, I'm sure, right? This is all very logical. It's a very logical subject. So we introduced the basic accounting equation. But that can expand into an expanded accounting equation. So all that means is that we are detailing the asset accounts, detailing the liability accounts, and then detailing the equity account. Assets can be detailed by saying cash plus an account called accounts receivable. Remember we said about the liabilities is accounts payable? Accounts payable meaning when we pay for something with credit and therefore we have a debt that we have to pay off. The opposite of that is that if our customers pay us with credit, they didn't give us cash, they pay us with credit. And therefore, to us, it's an accounts receivable. We are expecting them to pay off their debt to us. And therefore, we cannot increase cash, it's an accounts receivable. That's why it's an asset. And then when we do receive payment, guess what's going to happen? The accounts receivable will be converted into cash. Let's suppose somebody pays you with $50 cash with credit. You sell something, the customer pays you $50 with their credit card. When they finally pay you that balance, that $50 will be converted into cash, and therefore accounts receivable will decrease. Right? The logic continues. So that's why accounts receivable is an asset, is the opposite of an accounts payable. All related to credit. Just depends on the direction of that credit flow. What else is an asset? Equipment. Okay, these are generally the accounts that are used in the expanded equation. You could detail it more if you want, building, vehicle. You get the point though, right? These are the three that are generally used. Cash, accounts receivable, and equipment has expanded the asset portion of the basic accounting equation. And again, this is the expanded accounting equation. That means what is going to follow equipment? The equal sign. And therefore we are going to expand which category? Liabilities. And what do we say those are? Accounts payable, there we go. The sister to accounts receivable. Okay, hopefully you grasp why accounts payable is a liability and why accounts receivable is an asset. Okay? Plus, you could say notes payable. Again, notes payable is an accounts payable. It just has a promissory note, which is further guarantee that you will pay it. Okay? And then, so that details liabilities really. It doesn't need to go any more detailed than that. And equity now will be plus, and I will continue the equation down here. Here's that arrow. So it's the plus, right? We're bringing down that plus sign here. And now equity will start with a bracket because it is its own calculation in a way. We start with capital. That's going to be the first account related to equity. Right now we're expanding the E. Capital is the first account related to equity. When we generate revenue, remember category number 4? When we generate revenue, that means we made a sale or one of our services has produced revenue. When we do that, what happens to capital? What would you think would happen to capital if you generate revenue? Would it increase capital or decrease it? Is it good for your business or is it bad for your business to get revenue? Right. And if it's good for your business, does it increase capital or decrease it? Increases it. So therefore, it's a plus or a minus. You already know. Revenues, plus revenue. Okay? What was category number 5? Look at the sheet. You got the sheet right next to you where you wrote down all the categories? Refer to that. What is the 5th category? Expenses. If revenues increase capital, what would expenses do to capital? Logically, they would decrease it because they bring down revenues. If they bring down revenues, they bring down capital. Expenses. Minus. And then there's one more account that we're going to put here, which is the opposite of making a cash investment into the business. When you make a cash investment into the business, for example, when you first start the business, remember that $100,000 that we mentioned a few minutes ago? You start the business by investing $100,000 cash and $50,000 worth of equipment. That $100,000 cash is your capital, along with the $50,000 equipment. But let's say now, instead of putting money into and by the way, that $100,000 and that equipment belongs to the business now, since it has been invested into the business. It belongs to the business, and therefore it should only be used by the business. But if you do something like take out money from the business now, you put in that $100,000, but you take out now $500 for personal reasons. We're not judging here, but it could happen. So you take out the $500 from the business, that's called a withdrawal. So we're going to, if the investment of $100,000 increased your ownership, increased your capital, what is a withdrawal going to do to your business? Always think about the business. Again, accounting is recording what's happening to the business. When you take out money from the business, is that healthy for it or detrimental? Is it bad for the business? Okay, so we're going to minus then withdrawals, WD. For all you rust protectors out there. All right, WD-40s. WD, close the bracket now because you have expanded the equity portion of that basic accounting equation. And now all of this, from the cash to the withdrawals, is considered your expanded accounting equation. And now for the assignment, for the tests, when a transaction occurs in a business, let's say we've invested that $100,000 cash and $50,000 worth of equipment. Remember, assets must always equal liabilities plus equity. And if you're wondering about the camera angles, by the way, I just have the cords, they're tied up a little bit, so I'm utilizing the space according to the circumstances the best I can, I believe. So, but I hope I think you're getting this. I think you're getting a good view of it at least. All right, so where do we leave off? Lost my thought, I'll catch it, hold on. Yes, we use our example of a $100,000 investment into the business, cash, $50,000 equipment investment. That's a transaction. That's how your company started. That's an example of a transaction. Another example of a transaction would be we make a sale to a customer of chairs. We sell a bunch of chairs to the customer. That's a transaction. So we're going to show which accounts get affected by each of those transactions. Okay, we pay off one of our debts, one of our liabilities. That's a transaction, right? Or transactions can sometimes be called events in the business. So when an event happens, we just have to show which accounts get affected while keeping in mind that assets must always equal liabilities plus equity. Whatever we do to the accounts, that always has to stay true. Let's take our example of investing $100,000 cash and $50,000 of equipment. Which accounts on the left side will be impacted? Left side of the equal sign. Which accounts? If you've invested cash, has cash increased or decreased in the business? It's increased. So let's put an up arrow here, 100K. Right? Cash has increased by 100,000 because you've invested 100,000 into the business. When we say invested into the business, you put the money into the business. It belongs to the business now, wherever you got it from. Is accounts receivable relevant here? No, because nobody paid us with credit in this transaction. So we can skip that. How about equipment? Yes, because we've invested $50,000 of equipment. So is equipment increasing or decreasing? It's increasing by 50,000. Okay, so that's the left side of the equal sign, right? Remember, we're on the left side. Maybe I should be doing another color here to separate the equation from the transaction. So again, cash up 100K, equipment up 50K in the business. That's the left side, but we just said we have to always honor that assets equals liabilities plus equity. So now the left side increased by 150, but nothing has happened on the right side yet. But we know that the right side is also going to have to increase by 150. It's just which account will it be connected to? Is it a liability, accounts payable, notes payable? If we've invested into the business, is that a liability? Is that a debt? Of course not. So we're going to leave those blank for this transaction. But what about capital? Has that increased? Is our ownership in the business increased now? Surely it is. By how much? Capital up by 100,000? No. By 150,000. because of that equipment. So now guess what? The left side of the equal sign, 150,000, here's the equal sign. The left side of it goes up by 150. The right side of it goes up by 150. And therefore, you've satisfied the rule of matching both sides of the accounting equation. That's an example of a transaction. That's relevant for your assignment. It will be relevant for the test. Let's take another example. You make a sale on credit. Customer pays you with credit. That means you received cash or not? No, they paid you with credit. So if they pay you with credit, this is example number 1, example number 2 down here. They pay you with credit, what increases? Accounts receivable. What did we sell? What's our business? We're selling chairs? All right. We're selling chairs. How many did we sell? 100 of them? We sold 100 chairs. How much for each chair? $10? You want to do the simple math? Okay. $10 times the 100 chairs is $1,000, right? So $1,000, but they pay us with credit. Accounts receivable increases by $1,000. Anything related to equipment here? No. If our customer pays us, that means we didn't pay anybody. So therefore liabilities isn't applicable here. Has our capital increased? Yes, but we don't increase the capital account because we've made a sale here. So a sale, remember we said, is the same as saying what? Revenues. So revenues is sales. Okay? Sales revenue, sales, or just revenue. Saying the same thing. So that 100,000 means that the revenues go up 100,000. So just to align it with this, we'll say 1K and I'll just put an arrow to revenues. Up by 1K. There we go. Up by 1K. We made a sale on credit. Now when we look at the wider scope of it, the left side of the accounting equation has gone up by 100,000, or by 1,000, excuse me, and the right side of the accounting equation has gone up by 1,000. There you go. So instead of just saying that assets have gone up and equity has gone up, you are specifying the exact asset account and the exact equity account that has gone up. If it asks you the same thing for the basic accounting equation, let's say the same exact transaction, we make a sale of $1,000 on account, the customer pays us with credit, and that's another language thing in accounting. If it says sale on account or the customer pays you with credit, that both means a credit sale, right? It's just different language, but it means the same thing. So we make a sale on account of $1,000 and showing how that impacts the basic accounting equation. That means assets will increase by the 1,000 and equity will increase by the 1,000, but you don't have to specify the exact account. It just depends on if you're using the basic or the expanded accounting equation. Okay? Same thing with the 100,000 cash investment and the $50,000 equipment investment. If we're showing it in the basic accounting equation, we're saying assets increase by